Welcome to the Deep Dive.
Great to be here.
Today we're digging into the weekly brief. This one's from August 25, 2025.
Yep, fresh off the press.
And our mission, as always, is to pull out the really crucial stuff, the insights you need from all the latest global economic buzz and market moves.
Basically cut through the noise.
Exactly. Give you a clear view of what's significant, what you should maybe keep an eye on.
Sounds good.
And right off the bat, something jumped out. The UK. Seems they're facing a particularly tricky situation.
Oh, yeah.
Yeah, inflation just keeps surprising, keeps ticking up when maybe people thought it would ease off.
Okay, let's unpack that.
So the brief has this thought of the week section, and it really zeroes in on this UK issue. UK inflation, it accelerated to 3.8% year-on-year in July. Now here's the kicker. It's the fourth consecutive upside surprise.
4 months? Wow.
4 months in a row, higher than forecasts. It's not just a blip, it feels relentless.
Yeah, that kind of persistence is definitely notable. What does that actually mean for, people on the ground? And the economy overall?
That's the question.
Well, what's really fascinating, I think, is how these figures show these quite deeply embedded pressures. If we break down that 3.8% number, food inflation, the one you really feel every week, that climbed to 4.9% year-on-year, that's its highest in 18 months. And, importantly, it was 20 basis points, so 0.2%. Higher than what the Bank of England itself was predicting.
Right. So your grocery bill isn't lying to you?
Absolutely not. It's reflecting exactly that. I was just at the supermarket myself, and yeah, it definitely feels more expensive.
You really notice it, don't you?
You do. And it's not just food either. Services inflation also jumped, up 30 basis points, hitting 5%.
5%.
Now, okay, part of that was volatile stuff like airfares, summer travel, you know how it is.
Sure, seasonal peaks.
But the core problem seems to be these underlying pressures. Things like recent tax hikes hitting employers and wage growth, which is still pretty strong, feeding into those service prices.
So it's not just temporary factors, it's more systemic.
It suggests a broader, maybe more stubborn inflation picture than just a few volatile items would indicate. Yeah.
Okay.
And this really creates a headache for the Bank of England, a big one.
I can imagine.
They're caught, right. Rising inflation is pulling them one way, but then you've got a weakening labor market on the other side, which makes it much riskier for them to cut interest rates to try and help the economy, even though a weaker economy might need lower rates.
Right, the standard playbook is kind of out the window.
Exactly. The brief mentions their next meeting isn't until November, and it's looking, well, increasingly likely they'll just be on hold for some time.
Stuck between that rock and a hard place, as they say.
Yeah.
But isn't there a risk that by just staying on hold, they make the other problem worse, that weak labor market?
Oh, absolutely. That's the tightrope.
How do they even weigh those two things?
It's the classic central bank dilemma. Their main job, their mandate, is price stability. So inflation usually has to come first.
Right.
But yeah, keeping rates high for a long time will slow things down more, potentially costing jobs.
So they hope tackling inflation quickly is the lesser of two evils, long term.
That's the hope. Show resolve, bring inflation down faster, and then you have a stable base for growth later. But it's definitely a gamble. And the source uses that phrase, UK inflation shows no signs of easing.
Yeah, that really stood out.
Which just highlights why they probably feel they can't afford to ease up just yet.
That phrase, no signs of easing, it sounds quite grim. So beyond just things costing more day to day, what are the longer-term worries if this kind of inflation hangs around?
Well, persistent inflation, it obviously eats away at your purchasing power. Everything gets pricier.
Sure.
But it also creates a lot of uncertainty for businesses. Makes it harder for them to plan investments, hiring, the things that drive growth.
Right, that hesitation factor.
Exactly. And that can slow down the whole economy, slow down job creation. Plus, the bank keeping rates higher means mortgages, business loans, they stay expensive.
Affecting the property market, business expansion.
Everything. It really puts a drag on the whole system.
Yeah, a ripple effect that eventually touches everyone. Okay, so we've looked at the recent past, the UK's situation. But markets, they're always looking ahead, aren't they?
Always forward-looking.
So let's pivot to the week ahead. What are the big global indicators coming up that could shift things?
Right, looking forward is key. And this week, we've got quite a few important data points coming out across different regions.
Okay, what should we be watching?
In the U.S., a big one is consumer confidence for August. Last reading was 97.2. This tells us how optimistic or not consumers are feeling, which hints at future spending.
And consumer spending is huge for the U.S. economy.
Massive. So that's
Yeah.
important. And then crucially, core PCE for July. Year on year, it was 2.8% last time.
PCE. That's the Fed's preferred inflation measure, right?
Exactly. Personal consumption expenditures. This is the one the Fed watches like a hawk. So this number is huge for rate expectations.
Got it. Anything else from the U.S.?
We also get personal income and spending for July. Both were up 0.3% month on month before. Gives us more detail on how consumers are behaving.
Okay.
What about elsewhere?
Over in the Eurozone, we'll get economic sentiment for August. Prior was 95.8. It's a broad indicator, gives you a feel for the overall health and mood in the Eurozone.
A general vibe check for Europe's economy.
Pretty much, yeah. Then back to the UK, nationwide house prices for August, month on month. Last time it was up 0.6%.
Interesting, especially given our inflation chat. House prices link into consumer wealth, confidence.
Exactly. It's a good proxy for how households are feeling financially. And finally, China. We'll see the NBS General PMI for August. Prior was 50.2.
PMI Purchasing Managers Index?
That's right. It gives you a sense of the direction of economic trends in manufacturing and services, a key indicator for China's activity levels. Okay, so U.S. confidence in inflation, Eurozone sentiment, UK house prices, China activity. Quite a mix. Out of all those, which one do you think has the most potential to really shake things up this week?
Oh, easily the U.S. core PCE. No question.
Because it's the Fed's favorite.
Precisely. If that number comes in surprisingly high, it throws cold water on the idea that U.S. inflation is nicely cooling off.
Which could mean rates stay higher for longer than people expect.
Exactly. It could force the Fed's hand, or at least shift market expectations significantly. On the flip side, if it comes in surprisingly low,
then maybe rate cuts are back on the table sooner.
You definitely see markets react positively to that. Hopes for earlier cuts would surge. So yeah, that one data point has a lot of sway globally.
So you can really see how watching these diverse bits of data helps you build a picture, anticipate shifts, and understand why markets move the way they do.
It's like putting pieces of a puzzle together.
Okay, so how have these economic forces actually been reflected in market movements recently? Let's look at the snapshot from August 22nd.
Right, let's dive into the numbers. Looking at equities, the big picture is the MSCI AC World Index. That's a broad global measure. It was up 0.4% for the week.
Okay, modest gain.
Yeah, but year to date, it's up a healthy 12.3%. And over the last year, 17.6%. So generally, global stocks have been doing pretty well despite some of these issues.
Interesting resilience. Any regional differences?
Definitely. MSCI China had a strong week, up 1.5%, and year-to-date, China is actually up 30.1%. Over the last year, a massive 47.9%, really standing out.
Wow, China's performance is quite something.
It really is. The UK's FTSE 100 also did well this past week, up 2.0%, and it's up 17.3% year-to-date as well.
So good performance there too, despite the inflation woes.
Yeah, which is interesting, but it wasn't positive across the board in terms of sectors or styles.
Okay, tell me more.
Well, tech stocks actually dipped slightly, down 1.5% for the week, and growth stocks overall were down just a bit, 0.3%.
But value stocks?
Value stocks were up 1.3% for the week.
Okay, so a bit of a rotation there, maybe from growth towards value.
It could signal that, maybe investors are getting a little cautious, moving towards more established companies, perhaps reacting to the idea that rates might stay higher.
Makes sense. What about bonds? What are yields and spreads telling us?
Okay, so global investment grade spreads, that's the extra yield investors demand for holding stable corporate debt over government bonds. They're at 79 basis points, up slightly on the week, but still down 10 basis points this year.
Suggesting things are relatively stable for quality corporate debt.
Generally, yes. Now, looking at 10-year government bond yields, the UK's is at 4.69%. It was unchanged for the week, but it is up 12 basis points since the start of the year.
Reflecting those inflation concerns we talked about.
Exactly. Contrast that with the US 10-year yield. It's at 4.26%. That was down 6 basis points for the week, and it's actually down 31 basis points year to date.
So US yields are falling, while UK yields are stable to rising. What does that imply?
Lower U.S. yields could mean investors are maybe expecting U.S. growth to slow a bit, or perhaps they think the Fed won't be quite as aggressive going forward. It's a subtle shift in expectations compared to the U.K. picture.
Interesting divergence. What about commodities?
Brent crude oil was at $68 a barrel, up 2.8% for the week. Rising oil can feed into inflation, so that's one to watch.
Always a factor. And gold.
Gold was at $376 an ounce, up 1% for the week, but look at the year-to-date, up a whopping 28.6%.
Wow. That's a huge run for gold. Safe haven buying, inflation hedge.
Likely a mix of both. That strong performance definitely suggests investors are looking for protection against something, maybe inflation, maybe just general uncertainty.
Okay. And quickly, currencies and volatility.
Currencies saw small moves. The dollar per pound rate was 1.35, down slightly from 1.36 the week before, so the pound weakened a touch against the dollar, but the pound strengthened slightly against the euro.
Just reflects the different economic outlooks, I guess.
Pretty much.
Yeah.
And volatility, measured by the VIX index, the fear gauge, it was down to 14. That's lower than 15 the previous week, and down from 17 at the start of the year.
So less fear in the market. Calmer conditions overall.
It suggests market jitters have eased somewhat compared to earlier in the year. Yeah.
Right, that's a lot of market data points. Thanks for that sweep. So stepping back, what strikes you as particularly interesting or maybe even a bit odd given the economic backdrop we discussed?
Well, I think the general resilience of global stocks is quite striking, especially China and the UK performing well year to date, even with known challenges like UK inflation.
Yeah, it seems markets are looking past some of the immediate issues.
Perhaps. Or focusing on other strength. Also, that little rotation we saw, tech and growth dipping slightly while value rose, that feels significant. It could be a subtle shift towards caution, preferring solid earnings now over future potential, especially if rates stay high.
A quality bias, maybe.
Could be. And the U.S. bond yield drop is interesting, too. It seems a bit at odds with the Fed still talking tough on inflation. Maybe the bond market is pricing in a slowdown the Fed isn't acknowledging yet, or just seeing U.S. bonds as a safe place to be.
And the gold rally.
That screams underlying concern about inflation or stability, doesn't it? It shows the market definitely sees risks out there.
So if we were to play devil's advocate, what's the biggest counter-argument to that generally positive equity story? What's the hidden risk, maybe?
The main risk is probably that current stock prices are built on earnings expectations that are just too optimistic.
Especially if central banks do have to keep rates higher for longer.
Exactly. If inflation proves stickier than expected globally and rates don't come down as hoped, that could really challenge those valuations, especially in the high-flying areas. That U.S. bond yield drop could also be a warning sign about future economic growth, which wouldn't be good for stocks either.
Right, the risk of a disconnect between market hopes and economic reality.
That's always the tension to watch.
Okay, let's try and pull all these threads together now. Let's look at the high-level macro view and valuations from the tables in the brief. What does this combination, the diverse inflation picture, the different growth rates, the current market valuations, tell us about the overall investment climate right now?
Okay, looking at the macro table, the CPI inflation numbers really jump out. You've got the UK at 3.8%, like we discussed, then the US at 2.7%, Eurozone lower at 2.0%, Japan higher again at 3.1%, and China completely flat at 0.0%.
Just big differences.
Huge differences. It means central banks just aren't on the same page because they're fighting different battles. That creates very different paths for economies. Growth-wise, the U.S. looks solid at 3.0% GDP, China leading the pack at 4.5%.
So growth is there in key places, but inflation is all over the map.
Exactly. Now layer on valuation. We look at forward PE ratios, price to earnings based on expected future earnings.
Right, a measure of how expensive stocks seem.
Correct. The S&P 500 in the U.S. is at 22.5. MSCI World is 20.3. Those are, well, they're not historically cheap. They suggest investors are baking in quite a bit of optimism about future earnings.
High expectations built in.
Definitely. But then look at the UK's FTSE 100. It's at 13.1, much lower.
Suggesting UK stocks are seen as cheaper, or maybe just lower growth expectations because of inflation.
Probably a bit of both. So putting it together, you've got decent global growth overall, but very patchy inflation leading to different central bank actions. And you have some major markets looking quite fully valued while others seem less expensive.
So what's the strategic takeaway for someone listening?
It really screams diversification, doesn't it?
Yeah.
Different regions, different sectors are likely to perform very differently in this kind of environment. And those high PE ratios in places like the U.S. mean there's less margin for error if earnings disappoint.
Makes sense. Don't put all your eggs in one basket when the baskets look so different.
Like,
okay, that is a brilliant synthesis.
yeah.
We've covered a huge amount today, really digging into that UK inflation challenge, the tightrope central banks are walking.
Yeah, and looking ahead at those key global indicators.
And then connecting it all back to how markets have actually been behaving, the rotations, the valuations.
Absolutely. I think the key things to remember are those stubborn inflation pressures, especially in the UK, and the really delicate balancing act for central banks everywhere.
Right.
And just seeing how economic data constantly feeds into market reactions, how markets try to price in the future. Understanding that dynamic is so important.
It really is. Okay, as we wrap up this deep dive, let's leave our listeners with a final thought to chew on.
Okay.
Given this complex web, we've untangled the global economic currents, the specific issues like stubborn UK inflation. How might these big, seemingly distant numbers and trends actually ripple down to affect your own financial decisions? Or just the economic world you experience day to day in the months ahead? Something to think about.
Good question to ponder.
Indeed. Until next time, keep digging deep.